You see those three stocks all moving higher. Stock markets have been volatile since the release of disappointingly weak employment data in the U.S. on the second day of August. But my next guest does not believe the soft numbers point to a looming U.S. recession. He sees opportunity, moreover, in energy stocks, technology stocks, and home building sectors. Scott Ladner is Chief Investment Officer at Horizon Investments, and he joins me now. Scott, thanks a lot for joining us. The big concern of investors is the U.S. economy headed to recession or not? You say no. Why?
I mean, briefly, because of the kind of the starting place. Look, we're coming off of an amazing run in the economy in the United States. 7 or 8% nominal GDP growth. The best labor market in our history, and a Fed that everybody finally understands. So you have corporate America and the U.S. consumer both in extremely healthy shape from a balance sheet perspective. And meanwhile, we have a Fed that's like I said earlier about to start cutting rates. And so, that backdrop means that we can get slower numbers, and we've gotten slower numbers, Paul. There's no mistaking that things have slowed down here south of the border, but it is not, it's not a situation yet where we have weak numbers. We have weakening, but not weak numbers at all.
What is your view on the market volatility, i.e. the market declines we've seen since the day those weaker than expected jobs numbers were released?
Yeah, look, there are some uber technical explanations for some of that, having to do with some of the banks, some of the derivatives desks here in the United States having a lot of short exposure to the VIX, essentially. That combined with everybody's been talking about the yen carry trade, but there are all sorts of these types of events that essentially just led to one large margin call and risk manager move where banks in the United States had to go and buy VIX or sell S&Ps, the same kind of thing, just on beta adjusted basis. And at the same time, you had large hedge funds having to unwind some rather profitable positions. It just into a really bad liquidity market inside of August, and so we had a scary couple of days. But at the end of it, when people were finally able to calm down a little bit, we saw some price discovery, and we think that we could certainly get another one of those episodes in the coming couple of weeks as many managers and kind of senior people are still off the desks. But I don't think it actually pretends. I think there's a lot of noise in that signal rather than a lot of signal in that trading action.
The oil market, the price of crude oil has certainly zigged and zagged recently. Had a very weak month of July before rallying over the past trading sessions. You do like the energy sector in the U.S. equity market. Why so?
We do. It's actually one of the few cyclical sectors that we really do like right now. Partly because again, Paul, we don't see the recession either here or mostly globally. Outside of China is definitely still a problem child. But the rest of the world is we're going to see a growth upturn. We think second half of the year, not a continuing growth slowdown. So cyclicals and energy plays can benefit from something like that. And the curious thing with energy too, as we're all becoming aware, it can be a little bit of a hedge towards some of the geopolitical risks that we're seeing as well. So you get some offensive play out of the energy sector, but you get like at least a limited or a very precise sort of hedge towards some of the geopolitics that are troubling some markets right now.
As always, there's debate in your world, and I guess in our world as well, about technology stocks. How much exposure should investors have to this until quite recently high-flying sector?
Yeah, look, we think it's going to continue to be high flying. There's a reason why investors bid these stocks up and bid this sector up. We continue to think the best analogy for what we're going through right now is the mid-90s. The mid-90s saw certainly some excesses towards the end of it, but there were a lot of large and very successful companies that were built during that time. We think we're seeing the same thing with respect to the AI revolution down here right now as well. And so, yes, there's going to be some fraudulent behavior. There's going to be some stocks that are going to be overvalued. There's going to be some things that go too far. But at the end of the day, it's like the sector writ large is the focus of CapEx around the world. Everybody's going to be trying to plow money into these sectors, into these companies that can leverage the AI phenomenon and the productivity gains you can get out of it. And we just think that it's a place that you just have to be for at least the next few years.
U.S. home building stocks, the stocks of home builders, have rallied significantly since last fall when the market began pricing in the likelihood of lower rates from the Fed. I'm looking at a home builders ETF, ticker symbol XHB. Is there more to come as the reality of rate cuts gets ever closer?
We think so. There is still a fundamental housing shortage in the United States. There is going to be demand to build some of the, just build as many houses as you could possibly build. And as mortgage rates come down in the U.S., which they will over the next 12 months, albeit somewhat slowly, that's going to open up some more demand. People are going to be able to start to afford some of these houses again. And so, we do think that the home builders are one of the first direct beneficiaries of lower rates. So that's the primary reason why we think that you probably could get a leg out of that. You don't want the early cyclicals right now, but the home builders are an exception to that.
What sectors would you avoid right now, and are you avoiding?
Yeah, it is like, as I just mentioned earlier, it's the early cyclical stocks. So think about your junkier small caps or your deep value plays. Like these are generally going to be companies that really need a very, very strong growth rebound environment. So think of coming out of a recession, coming out of a big slowdown. The first leg of growth after something like that is usually pretty sharp, and it's kind of in a V fashion. We don't think we don't see that type of growth trajectory coming. We think there's more of a U. So if you don't get the really, really big slowdown, you don't generally get the really, really big speed up either. And we don't think we're seeing a slowdown, but not a big one. And we don't think we're going to see that kind of V-shaped economic recovery that's usually necessary for those junkier small caps and deep value plays to really win.
Does that include the metals and mining stocks? And I ask that question because there tends to be a lot of optimism these days around the price of copper in particular, which often leads that sector higher.
Yeah, Paul, it's a great question. It's probably, frankly, it's a sector you guys know better than I do. But the reason why we don't love metals and mining stocks in general right now is outside the gold miners. I'm talking more about like industrial metals, is because of the China problem. China is in the throes of a balance sheet recession. The government doesn't seem to want to do anything fiscally to try to stimulate, which is the only way out of a balance sheet recession, a la Japan for 25 years, the United States after the great financial crisis. You just need big fiscal spending to stimulate aggregate demand in a situation like that. We don't think we're getting it. And outside of Chinese demand really coming through on the industrial metal side, it's usually pretty tough sledding for those types